NY potential drawbacks. Balance transfer impact? A balance transfer can have several impacts on your credit and overall financial situation. While balance transfers can be a valuable tool for managing and paying off high-interest debt, it's important to understand both the positive and negative effects they can have on your credit score and finances. Here's a detailed breakdown of the potential impacts. Positive impacts of a balance transfer. 1. Lower interest payments. Savings on interest. The primary benefit of a balance transfer is the ability to move high-interest debt to a credit card with a lower interest rate, often 0% for an introductory period. This can save you money on interest payments, allowing more of your payments to go toward the principal balance. 2. Debt payoff acceleration. Faster debt repayment. By reducing or eliminating interest charges during the promotional period, you can pay off your debt faster. This can help you become debt-free sooner, provided you make regular payments and avoid accumulating new debt. 3. Potential credit score improvement. Lower credit utilization. If the new card has a high credit limit and you don't max it out, a balance transfer can lower your credit utilization ratio, the amount of credit you're using relative to your total available credit. A lower utilization ratio can positively impact your credit score. Consolidation of debt. Managing multiple credit card payments can be challenging. A balance transfer consolidates your debt into one payment, which can make it easier to manage and reduce the risk of missed payments. Negative impacts of a balance transfer. 1. Short-term credit score dip. Hard inquiry. When you apply for a new credit card for a balance transfer, the issuer will likely perform a hard inquiry on your credit report. This can cause a temporary dip in your credit score, usually by a few points. New account impact. Opening a new credit card account can slightly lower the average age of your credit accounts, which is a factor in your credit score. This impact is usually minimal but can be more noticeable if you have a short credit history. 2. High post-promotional APR interest rate spike. If you don't pay off the transferred balance before the introductory 0% APR period ends, the remaining balance will start accruing interest at the card's regular APR, which can be high. This could negate the benefits of the transfer if not managed carefully. 3. Balance transfer fees. Upfront costs. Most balance transfer cards charge a fee for transferring a balance, typically 3% to 5% of the transferred amount. While this fee is often worth paying to reduce interest costs, it's an added expense that should be factored into your decision. Reduced savings. The balance transfer fee can reduce the overall savings you achieve through the lower interest rate, especially if the transferred balance is large or if you don't pay off the debt within the promotional period. 4. Potential for increased debt. Temptation to spend. Once you've transferred your balance to a new card, your old credit cards will have available credit. This can be tempting to use, which could lead to more debt. It's important to avoid using the old cards unless you can pay off the new charges in full each month. False sense of relief. A balance transfer can create a false sense of financial relief, leading some to believe their debt problem is solved. However, without a solid repayment plan, the debt can remain or even grow. 5. Impact on credit utilization ratio. High utilization on the new card. If the balance you transfer is close to or exceeds the credit limit on the new card, your credit utilization ratio on that card will be high, which can negatively affect your credit score. It's important to keep your utilization low by not maxing out the new card. 6. Potential penalty APR missed payments consequences. If you miss a payment on your new balance transfer card, you may lose the promotional APR and be subjected to a higher penalty APR, which can significantly increase your costs. How to mitigate negative impacts. 1. Plan your payments. Create a repayment plan. Calculate how much you need to pay each month to eliminate the balance before the 0% APR period ends. Stick to this plan to avoid paying high interest after the promotional period. 2. Avoid new debt. Refrain from using old cards. Don't rack up new debt on the old cards that now have a zero balance. Consider keeping them in a drawer or even freezing them to avoid temptation. 3. Monitor your credit. Keep an eye on your credit score. After the balance transfer, monitor your credit score to track any changes. This can help you understand how the transfer has impacted your credit and allow you to make adjustments as needed. 4. Pay more than the minimum. Accelerate debt payoff. Whenever possible, pay more than the minimum payment on your new balance transfer card. This will help you pay down the principal faster and reduce the risk of carrying a balance into the high interest period. 5. Use the balance transfer strategically. Avoid multiple transfers. Constantly transferring balances from one card to another can negatively impact your credit and lead to increased fees. Use balance transfers strategically, and aim to pay off the balance during the 0% APR period. Conclusion: a balance transfer can be a powerful tool to help you manage and pay off debt more effectively, especially if you're dealing with high-interest credit card balances. However, it's crucial to approach a balance transfer with a clear plan and a full understanding of the potential impacts on your credit score and financial situation. By using the balance transfer responsibly, paying off the balance during the promotional period, avoiding new debt, and managing your credit utilization, you can maximize the benefits and minimize any negative consequences.